Hi, Giji. Welcome.
Good afternoon.
Thank
So
you.
glad to be here.
Thank you so much for being here. You are really great professionals. I saw you on LinkedIn. Your profile is awesome. Today we're going to talk about financial literacy. Um,
Excellent.
Before we get there, I wanted you to tell everybody about you.
Okay. Hi, my name is Giji Dennard. I am a speaker, an author, and what I'd like to call a financial solutions architect. I work in financial services to help people learn how to make money, save money, and get out of debt. But I'm also an author and motivational speaker and trainer in staff development.
You also have your own business and your website.
Yes.
Don't mind if you can talk about it.
Absolutely. So the name of my business is WellFed Resources. And I'd like to think of it in terms of 360-degree wellness, where I provide products and services to help people be well and be whole in spirit, soul, body, and business. So I have a number of books that I've written and published. I also conduct workshops. In service excellence, leadership, and other arenas. I am working on developing 2 podcasts,
Okay.
and I've done a number of speaking engagements, particularly in the faith-based space,
Okay.
where I talk about healing in father-child relationships.
Wow, that's great. So you also have the financial literacy section.
Yes, please.
Is what we're gonna talk about today. So for
Yes.
someone who's new like me, someone don't know where to start, what is financial literacy and why is it important?
Well, financial literacy is really just the idea that we need to know how money works in society, in this country, and we need to know how to work money to our advantage. What typically happens is people make money, and then people don't understand why they're struggling. And so they don't know how to make money work for them. And unfortunately, it is a great majority of Americans, but particularly underserved communities, women, minority communities, younger people in millennial, Gen Z, Gen X generations who have no idea how the system works. Unfortunately, the financial services industry has not been available to those communities to a large extent. And I'm part of a movement to make sure that that changes.
Yeah, because a lot of people talking about it right now, financial literacy. The first thing that came to mind, what it is, right?
Yes.
So basically, you mean is to how to make smart decisions about money, right?
It's how to make smart decisions about money, right? And how to make your money multiply for your benefit instead of benefiting the banks or benefiting the government or benefiting even your employer.
Okay. Wow. So especially for young people, it's
Yes.
So what are some of the benefits of financial literacy?
Well, what financial literacy does is it equips you. What I say is people can't do better unless they know better.
Right.
Right. And so what I want to help people do is know better, know that there's a better way to make use of the income that you're earning, regardless of how you're earning it. Something I wish I myself had learned 20, 30 years ago instead of when I learned it. I would have been in a much better position financially at this stage had I learned it much earlier. So I think it's particularly important for young people at the height of their earning potential to be able to learn how to start making that money work for them and learning things about the way different entities interact with their money. We, for instance, talk about in our education workshops, we talk about the ways that money grow. Okay. And people don't understand that in America, really, there are only 3 ways that money grow. It either grows fixed, it grows variable, or it grows indexed. Those are the only options. But a lot of people don't know what that means, and sometimes they don't even know If they have an idea of what it means, they don't really know how it works on a day-to-day. If they're losing money, if they're gaining money, that kind of thing, they don't understand it. And so we help make it simple and get, it's really something that everybody can and should learn.
Okay. So how to make money work?
Yes.
So how can you do that? How can you do that?
Well,
how to make money work for you?
Yeah. So let's kind of talk about those concepts that I just mentioned: fixed, variable, and indexed. Okay. So these are the ways that money grows. So when we talk about fixed, we're really talking about things like your bank account,
Okay.
CDs, money market accounts, that kind of thing, right? Or, some people still keep money like underneath their bed or in their freezer, stuff like that, right? So we call those fixed accounts, and they're fixed because they're safe. Reasonably speaking, barring a bank failure like the recent one, but reasonably speaking, in a bank, your money is guaranteed up to $250,000.
Okay.
So if you have the money in the bank, it's relatively safe. It's not going anywhere. However, what happens is there is no rate of return on that money.
That's correct.
At best, we're talking 1%, and that's like an outlier. And so that money is never outpacing, the growth on that bank money is never outpacing inflation, like never. So as inflation increases, the money that you have available, the value of that money is actually decreasing.
Right.
Right?
Right.
So people don't understand that. So people might have, $250,000 sitting in a bank, and there are ways that there are other instruments where they could put that money and actually have that money grow rather than sitting in the bank collecting nothing and devaluing over time, right?
All right.
And they have no idea that those plans are in the market. So whatever happens in the market happens to their money.
Right.
And for the last 6 to 9 months, a lot of people are clueless as to how much money they have lost in their 401k.
Wow.
So if they were to retire in the next 3 years, the amount of money they thought they would have will no longer be there. So we teach them about these kinds of concepts, right? Because a lot of times people have these products, have these instruments, but they don't know how they operate. The other type of product is an indexed product. And unfortunately, I would say among all the clients with whom we speak, probably 99% of them have not heard of indexed accounts.
Right.
So if you've never heard of it, right, you can't take advantage of it. And what indexed accounts offer are both the growth of the market without being in the market. They're being protected. They're just trapped against the market, but your money's not in the market. So you can't lose any money. It's actually a contract that says you cannot lose any money. 0 is the floor. So you'll never lose money, and you'll grow money at a specific rate, but it'll outpace inflation. It might not hit all the gains of the market, but you'll always gain something if the market's up, but you'll never lose money.
So that's index account.
That's index accounts. You'll never lose money. And then on top of that, you can withdraw money from your own money, okay? Because indexed accounts are life insurance products. And people don't understand how life insurance is a valuable money-making tool. So you can actually put money in an indexed account, have your money grow with the market, and borrow from your own money without it affecting your growth. And that's because the loan comes out of your death benefit. It doesn't come out of your cash accumulation. So it comes out of your death benefit. You can, let's say you've got $60,000 that you want to take out of your $100,000 account. It comes out of the death benefit. So nothing happens. Your money will continue to grow as if you had $100,000. You take that $60,000 out to buy a boat or put down a deposit on a house or take care of a sick parent. And that money continues to grow, and you can pay it back or not pay it back. And when you take that money out, it is completely tax-free because insurance money cannot be counted as income. So you have to pay no taxes on it. You can determine whether you put it back or not. Your money continues to grow, and you create what's called infinite banking. Your money continues to grow. You can put money in, take money out, put money in, take money out. A lot of people don't know that places like Disneyland were built from insurance policies. We teach those kinds of things to help people know even what's out there.
Wow. So where do you go to open an index account?
So people like us who work in financial services actually are able to offer those kinds of products to you. We sit down with each individual. So it's a highly regulated industry, right?
Right.
So we can't just you can't just grab somebody off the street and ask them how to do this, right? So it's a highly regulated industry. We're all licensed agents. And like doctors, we don't just sit down and say, okay, you ought to do this and you ought to do that. Like if you walked into a doctor's office and they never examined you or anything and they started prescribing you medicine, you would think something was very wrong.
Right.
And so in a similar way, we do the same kind of thing. We do a diagnosis, sort of a financial diagnosis. We sit down with you. We talk about specifically what your goals are. Some people are looking to build retirement fund. Some people are more focused on building a college fund for their kids. Some people are just wanting to make sure that they have money available in case of an emergency. So there are several different areas that we look at. We ask you to rank them. And then based on your desires, what your goals are, then we start looking at what you bring in, what you've got going out, what kind of debt you're trying to manage right now, what your liquid and non-liquid assets are, and then what your monthly expenses are. And we go over that with you so that we can see, okay, because sometimes people say, well, I want to, put away $100,000, right?
Right.
Well, if they only have $150,000, we're going to say that probably isn't the safest thing for you to do, particularly if you're over 50, because everyone should have, if possible, 4 to 6 months worth of emergency funds in a liquid account that they can access readily, like in the bank. We believe in all of them, fixed, variable, and indexed. But people kind of don't know what to do with what money when. And so sometimes people say, well, I want to put this money away. And we might say, well, that would be great, except for the fact that that doesn't really cover your expenses that you've outlined for the next 4 to 6 months. You probably want to keep at least that much in the bank, and then we could put the rest in an account that can grow for you. So it's a very individualized sort of assessment based on your financial needs, your age, your health, all of that kind of stuff to determine what might be the best product for you.
Wow.
So there's indexed universal life products as well as fixed indexed annuity products.
So we have fixed accounts, index accounts. So if you can come back a little bit on the variable accounts.
Sure.
A little bit.
So the variable accounts are, like I was saying, particularly the 401k, 403b, TSP kinds of accounts. The positive on those accounts is that they can grow. You can make a lot of money in those markets. When the market goes up, it can go up a lot, and people have and make a lot of money. The downside is that what goes up inevitably comes down, right? And if we look at history, we look at what happened in 2001, even if we don't go back like far history, we go back to 2001. So when the Twin Towers fell and the economy crashed, people lost money. In 2008, when the housing, market bubble burst happened, people lost money. Over the past few years, you've got people running around in masks. You've got businesses closing down. The market has been very volatile. And, when the market drops 24, 38%, people lose a lot of money. So the question becomes, how much money can you afford to lose? For most people, the answer is little to none. So only the really wealthy and the really young, can really afford to lose that kind of money.
Right.
And bounce back from it. But most people really can't afford to lose that kind of money. And a lot of times they don't understand that they are. So the kind of solution that we can offer is we can actually take the money that you are now putting into your 401k, for instance, if you're particularly for over 59 and a half, so there's no penalty, we can roll that money over into a fixed indexed annuity, which then will continue to, grow money, and you can have it access tax-free, and there's no charge in that because you're 59 and a half, you can roll it over in a 1035 transfer. If you're under 59 and a half, let's say you're funding your account $500 a month, but your company is only providing $250 match. What we would recommend then is you only put in $250 to match what the employer's doing, and you take that other $250 a month and put it into an IUL. So that, again, you're growing money, you have access to it. And the other thing that's really cool about the IUL is that it also comes with what we call living benefits. So a lot of times what people misconstrue the idea of life insurance and think it only has to do with you when you die, right? But that's not true. So insurance actually comes with, today's insurance comes with what's called living benefits. So terminal illness, chronic illness, critical illness, and critical injury, you can have access to up to 90% of your cash value to address those things. Most people get sick or have some major calamity before they die. And a lot of people lose their retirement savings and stuff like that because they have an illness where they have to pay off medical bills and stuff like that health insurance won't cover. But in these kinds of products, they actually can borrow from their death benefit while they're alive to take care of those issues, and their money continues to grow in that account.
Wow.
Yeah, very powerful tool.
Yeah, that's very powerful. So what is the IUL?
So the IUL stands for Indexed Universal Life. So it's a life insurance product, and by tax code 7702, it's tax-free money, and insurance has a disposition not to lose money. So when we create an IUL, you can either make monthly payments or you can do like a lump sum payment, but you can put money into this account. There's a cash accumulation segment to this account. You can determine whether you need more or less insurance. So it can be structured in different ways. So again, it's an analysis based on your needs, your age, your goals. But it can be structured either to kind of balance out insurance to cash, or we can get the minimum insurance that we need so that there can be more cash, or we can do in the reverse. If you need more insurance because you don't have enough insurance coverage for you and your family, then we can increase it and we can decrease the amount of cash accumulation.
Yeah, this is good stuff.
Yeah.
You know about, fixed account, variable account, index account. This is very, very interesting. This is why financial literacy is important.
Yes, it's so important.
I'm sure most people don't know about this.
Correct. Most people don't know about this. Most people outside of the financial service industry have no idea about these products that can really be beneficial to build a legacy for their family.
Wow. So how about, we talked about emergency funds.
Yes.
So is that 4 to 6 months?
4 to 6 months. Yeah, of your monthly expenses, every person should have on hand in a very liquid account. 4 to 48 hours, that's kind of how we define it. One of the other parts of the workshop is talking about the 5 homes of money.
Okay.
So when we look at the 5 homes of money, liquidity is one of the first things we look at. Can you access your money within 24 to 48 hours? Banks, you can do that, yes. In some stock accounts now, with things like Robinhood and Acorn, you can actually access money from the stock market these days in 24 to 48 hours in some kinds of accounts. And in life insurance, you can access your money in these indexed accounts within 24 to 48 hours. You cannot, however, do that if your money's tied up in real estate And you cannot do that if your money's tied up in qualified plans, like your 401k. Those are not readily, liquid. So that's one of the measurements that we look at to determine where's the best place to put the money once you actually identify, okay, I've got this money. How can I make it work for me? A lot of it has to do with putting it in the right home.
Wow. So you have emergency fund, 4 to 6
Yes.
fund, especially right now with a lot of
Yes.
layoff. So
Yes,
it's
absolutely.
important to people to have this kind of backup.
Absolutely. Absolutely.
Wow. So how about budgeting? Having a budget, you're saving, you're spending, maybe a little bit of your credit score. If you want to touch a little bit about this point.
We don't really do budgeting per se. We help people assess whether or not what they're spending kind of makes sense for what their needs are, maybe. We don't really do like budgeting instruction so much, but we might give you an analysis. So for instance, if someone has a very low discretionary income and they're spending a lot of money on non-essentials, we might recommend, just make note of it and say, you would have more money to grow money from your discretionary income if perhaps you cut back on some of these non-essentials. Because 45% of your income is being spent on non-essentials. So you might want to look at ways that you can cut back, and that will put you in a better position to put some more of your discretionary income in somewhere that can grow money for you. So we might give that kind of advice.
How about saving?
So savings kind of goes back to the whole emergency fund thing.
Right.
So besides, an account where you can access it for bills, so you should have kind of the rolling amount of money for your bills, and then, 4 to 6 months for emergencies. Okay. But besides that, because money in a bank isn't doing anything for you, that's all we really recommend you having in a bank.
And then about investing, what's your thought on that?
So again, investing, a lot of that has to do with where you are and how much risk you can afford to take. So you've probably heard of Warren Buffett, right? The decabillionaire.
Yeah.
So Warren Buffett has 2 rules of money. Rule number 1 is don't lose money. Okay. Rule number 2 is don't forget about rule number 1. He keeps it simple because Warren Buffett understands the concept of principal protection. And what principal protection demonstrates is that it takes you twice as much to gain back money that you lost than what you had at the beginning. And people don't understand that. We do this in our workshops. We do this simple exercise where we say, let's say you have $100. Stock market drops 50% tomorrow, right? What do you have left? $50. You have $50. Great. So miraculously, the stock market goes back up 50% the next day. So what do you have?
$100.
That's what people say. You don't. You only have $75.
$75.
Because you only had $50. It went back up 50%.
Yes.
And now it's gone back up 50%, but you don't have what you had at the beginning.
Yes.
That's called the principal protection rule. So the goal is to not lose money because you have to work too hard to get it back. He's not saying don't grow money, but don't lose money. So if you are 50 and older and want to retire in your early 60s, then you don't have a lot of wiggle room to play with money, in the market. Investments that are risky, Even with real estate, you can make a lot of money in real estate, but people have lost their homes, lost their shirts, real estate investing, not understanding, that this is not a surefire thing. And that's why we encourage diversification and making sure that you have some money in places that won't lose money.
Yeah. Wow.
Yeah.
It's good. This is a really great advice. How about credit score? Because a lot of people, have a lot of credit card debt. A lot of people,
Right. That is always not a good thing.
a lot of people don't have an issue with their credit score, which is very important to have a loan or to have credit card. Any thought on that?
Well, credit score is not really my wheelhouse, but I will say that our agency, PHP agency, which stands for People Helping People, we actually have a debt mediation solution arm. So when we meet with clients who may have a debt problem, particularly if it's credit card or any loans that are non-federal, we refer them to our debt mediation solution arm. Because we have a whole team of people that's what they do. That's not really what I do, but we have people that do that.
Okay.
And so we refer them to those people to help with resolving debt, because obviously that's one of the first things that is at least one of the critical components of wealth building is debt reduction and elimination, if at all possible.
Wow, this is good. It's really good stuff. So for everyday people, someone who want to buy a house,
Yes.
Any thought on that? Especially, we have interest rates going up.
Right. Sure. So let me come at it from this perspective. The more you are secure with money that you can access tax-free, the better position you are to being able to really afford buying a home. There are, lots of ways to do it, but if you want to do it and end up not in a debt situation, one of the ways to do that is to build some money up through like an IUL, from which then you can withdraw money to actually purchase a home. Now, once you get a home, it's important that you have mortgage insurance. So let's say, you buy this home, but if something happened to you, will you be able to continue to pay the mortgage if you got ill or if one of the breadwinners, God forbid, were to die? So one of the things we offer, which is not exist in, say, car insurance, but it does exist in life insurance, is something called an ROP term that we often recommend for mortgage insurance. So you can get a term policy that's a decreasing term. And so over time, you're putting less and less into the policy. And it tracks against your mortgage. So you can get a 15-year, 20-year, 30-year life insurance policy, depending on the length of your mortgage. And over time, what happens is you've got money covering you and your mortgage in case anything were to happen, right? But what's really cool is, let's say 30 years comes and goes, you've put $36,000 into this policy to cover your mortgage. Your mortgage is paid. Everybody's well and alive. On an ROP term, you get back all that $36,000. So it's called return of premium. It doesn't exist in car insurance, but it does exist in life insurance. It would be nice if it existed, right? Geico gave us back our money if we didn't get in an accident, right? Yeah. But it does exist in life insurance. So that's not only a way to protect your mortgage, but a way to then recoup those premiums that you paid for the last 20, 30 years. At the end of that, you get a check cut immediately.
Wow, this is really interesting. Someone who want to buy a house.
Yes.
So you use an index account.
Yes.
Like an IUL. And,
yes.
And use that to buy the house.
Yes.
And then have a mortgage insurance.
Correct. Yeah, with an ROP term that gives them their premiums back at the end of the term.
Right.
Yeah.
Wow.
So again, it's learning how to be smart with your money. That's what we help teach people.
Wow. Wow. So how the interest rate right now is going to impact the financial products?
Well, the thing that's cool about indexed accounts is that you really can't lose no matter what happens to the interest rates. In those indexed accounts, 0 is the floor, and therefore 0 is your hero. So no matter what happens to the interest rates, you're not going to lose money. All it's going to impact is the rate of growth and the spread of growth of your growth. So you'll either get a little growth or you'll get a lot growth, but you're never going to lose money. So that's one of the other cool things about financial service products is that they are really recession proof. Wow. So no matter what happens with the interest rates, you're not going to lose any money.
Rule number one, don't lose money.
Exactly. It all goes back to rule number one. Don't lose money. And so particularly at a time like that, these are the kinds of products that people need to be placing their money in because the interest rates are increasing and the market's so volatile. And I don't believe that we've seen the end. I mean, it's been bad, but it's gonna hit. If we haven't hit the bottom yet. So you don't want to have all your eggs in that basket when the bottom hits.
Right.
Because worst case scenario, you make no extra money, but you absolutely won't lose any money when that bottom drops.
So how do someone become financially literate? Someone can say, hey, now I'm good, I'm financially literate, or that this is a lifelong journey?
Well, I think it's a lifelong journey in part because like everything else, things advance. A lot of times we talk to clients and we start talking to them about permanent policies and they say, oh, you mean like whole life? Well, the whole life policy of 2016 is very different than whole life policies now because regulations change, products and services change in financial services just like everywhere else. So those products have been upgraded. A lot of people don't know that. So those 2016 policies don't have living benefits. So people are paying through the nose for long-term care and disability insurance, which is extremely high. Whereas these new policies come with living benefits that take care of all of that. Yeah. So there'd be no reason to purchase extra long-term care and disability when you've got these index universal life policies. So again, a lot of times people just don't, you need to keep up with what's happening, and so yes, financial literacy is a lifelong process. It's no way to learn everything. There are a lot of resources out there. There are books to read, there are YouTube videos to watch. But it's evolving just like everything else.
Why we don't teach this in high school?
That's a really good question. I think it ought to be taught probably as early as junior high. I agree. I think it's absolutely one of the travesties of public education is the fact that we're not teaching young people how money works in this country. And so what typically happens, the pattern is people completely mess up in their 20s and 30s. They mess up their lives, they mess up their credit, they mess up everything because they have no idea what they're doing. Then they realize they've messed up, like mid-30s, late 30s, and then they're trying to fix it in their 40s and 50s, and then they're not really prepared for retirement in their early 60s because they couldn't recoup over that time. They hadn't figured out what to do yet. Yeah. So yeah, it's a travesty of public education that we're not educating people and much younger.
Yeah, someone like I have a background in engineering, like have a degree, but a lot of things you're talking about, I have never learned.
Exactly. Exactly. We have a lot of professionals out there, and a lot of in careers like engineering, IT, even legal fields and stuff like that, medical fields where people weren't taught it. Yeah. And so yes, that is our mission. Our mission is to get the word out, and particularly in those communities who've never been exposed to this kind of education before. And so, we offer for people who are in the DMV area, we actually offer in-person workshops that are free of charge, no obligation, to come and learn these things on Tuesday nights and Saturday mornings. If you're remote and you're in other places, we have Zoom. We'll jump on a Zoom call with you. We even have videos that we can send you links to where, somebody's teaching these concepts so that we can get the word out.
Yeah, it's really awesome what you're doing there. So for someone who has a financial advisor, what are the questions they can ask their
Okay.
advisor?
Yeah, if you already have a financial advisor, first, I think it's very important that your financial advisor is checking in with you at least every 6 months, particularly if you have any money in variable accounts, because they're moving. And if, a financial advisor who's worth his or her weight in gold will make sure that adjustments are being made to your portfolio that will protect you. And not just leave it to chance. I think you should be asking your financial advisor if they haven't offered, are there any updates in products and services? Are there any changes in what are the best indexes, to use for the growth of my money? There are a lot of index options out there. And so again, as markets change, international markets change, the global economy changes, it's important that your financial advisor is keeping a watch on those kinds of things, because that also will affect the growth or decline of the money that they are stewarding for you.
Okay, that's good. That's good. So for young people, I want to talk a little bit about retirement.
Okay.
How can you be, prepared for retirement, especially if people who have time to be prepared?
Start early. Start as early as possible. We have agents who are in their early 20s who have already begun building generational wealth. Because a lot of times people think about retirement in a static kind of way. But what we know is that the value of money decreases, inflation increases quite often. So even if, let's say you're making $250,000 now, when you're ready to retire 10, 20 years from now, that $250,000 will no longer be worth $250,000. So what you may be comfortable with now, you may not be comfortable with in 10 to 20 years, because it's the dollar's not going to have the same value. Yeah. So it's important that in retirement planning, you're thinking about the valuation of your money, not just a number. So that's why it's important to start as early as possible. Start building money in a safe account. Don't blow it all on stocks, even though you're young. You can afford to blow some. Sure, have at it, because you can afford to make some. But don't put it all into a market that's volatile. Put some good money away in a place that's safe, where you can't ever lose money. You can keep growing it. As it grows, then you can afford to pull some out. Play with it in the market or whatever. But start growing it as early as you possibly can. And that way you can ensure that you and your children, are set.
Wow. Hey, this was awesome. I know you have a busy schedule. I'm gonna probably let you go, but we talked about a lot of things: financial literacy, those accounts. That was really awesome. Fixed, variable, and index.
Yes.
It's so where people can find you, like you help people, how people can reach out to you.
Sure. So one way that people can reach me is actually through my website. They can contact me directly at www.wellfedresources.com.
Yeah.
The other way that people can reach out to me is on LinkedIn. You can find me directly on LinkedIn. So I have a profile there. I'm also on Instagram and Facebook at WellFed Resources. So feel free to DM me and we can connect, and I'd be happy to help in any way that I can.
All right. Yeah, that's awesome. Yeah, I'm gonna add your website links in the description. And
Thank you so much.
yeah, thank you for giving me your time. Thank you.
Absolutely. This has been a lot of fun. I really appreciate being able to get the word out. It's very much needed in our communities.
Yeah, hopefully we can do this again in the future. It was very inspiring for me. I learned a lot.
Thank you.
And also I appreciate you. I want to congratulate you on your career. You are really I mean your LinkedIn profile is awesome. You have a lot of experience. You have a doctor of law degree. You still have the energy to keep going. You have your website.
Gotta keep going. Yeah.
You're so inspiring. Thank you for
Thank you so much. Thank you so much. I really was an honor to be on your channel, and I look forward to communicating with you in the future. And maybe we can do this again.
I'm here. Thank you. Bye bye.
Thank you. Bye-bye.